Imagine you're loaning money to a friend. You'd probably want some assurance that you'll get your money back, right? Bonds work similarly. They're essentially loans you give to governments or corporations. When you buy a bond, you're lending money to the issuer for a fixed period. In return, the issuer promises to pay you regular interest payments, known as coupons. At the end of the bond's term, you receive your principal back. Think of it like this. You lend $1,000 with a 5% annual interest rate for 5 years. Each year, you'd receive $50 in interest, and after 5 years, you get your $1,000 back. That's a bond in a nutshell. Bonds are a vital part of the financial system. They allow governments to fund projects and corporations to raise capital, all while providing investors with a relatively predictable income stream. Why do bonds exist? What purpose do they serve in the grand scheme of finance? For starters, bonds provide a way for entities to borrow money directly from investors. Instead of going through banks, governments and companies can issue bonds to raise capital. This benefits both the issuer and the investor. The issuer gets funding, and the investor receives a stream of income through interest payments. It's a win-win situation. Think of it like this. A company wants to build a new factory. They could take out a bank loan, but they decide to issue bonds instead. Investors buy these bonds, providing the company with the necessary funds for the factory. This process is happening constantly in the financial markets. Governments issue bonds to finance infrastructure projects, and corporations use them to expand their operations or fund new ventures. Not all bonds are created equal. Just like there are different types of stocks, bonds come in various flavors, each with its own risk and return profile. The most common types are government bonds, considered very safe, and corporate bonds, which carry more risk but offer higher potential returns. Within each category, there are further distinctions. For example, government bonds can be short-term, like treasury bills, or long-term, like treasury bonds. Corporate bonds are graded based on the issuer's creditworthiness. A highly rated company will offer lower interest rates than a less creditworthy one because the risk of default is lower. Navigating the risks of bond investing. While bonds are generally considered less risky than stocks, they are not without their risks. Understanding these risks is crucial for making informed investment decisions. One significant risk is interest rate risk. When interest rates rise, the value of existing bonds tends to fall. This is because investors can buy new bonds with higher yields, making older, lower-yielding bonds less attractive. Another risk is inflation risk. Inflation erodes the purchasing power of money over time. If inflation rises faster than the interest rate you're earning on a bond, your investment's real return diminishes. Credit risk is another factor, mainly with corporate bonds. This is the risk that the issuer might default on their debt, meaning they can't make their interest payments or repay the principal. Bonds and your investment strategy. So, how do bonds fit into an investment strategy? The answer depends on your financial goals, risk tolerance, and time horizon. Generally, bonds are considered a more conservative investment than stocks. They can provide a steady stream of income and are less volatile than stocks, making them suitable for investors nearing retirement or those with a lower risk tolerance. However, investors with a longer time horizon and a higher risk appetite might allocate a smaller portion of their portfolio to bonds, as stocks have historically provided higher returns over the long term. Remember, there is no one-size-fits-all approach to investing. The key is to create a diversified portfolio that aligns with your individual circumstances and financial goals. The importance of diversification. Diversification is the cornerstone of a sound investment strategy. It involves spreading your investments across various asset classes such as stocks, bonds, and real estate to reduce risk. By diversifying your portfolio, you're not putting all your eggs in one basket. If one asset class performs poorly, the others can potentially offset those losses. Think of it like this. If you invest all your money in a single company's stock and that company goes bankrupt, you could lose everything. However, if you had diversified your portfolio, the loss from that one stock would be cushioned by the performance of your other investments. Bonds play a crucial role in diversification. They can help mitigate the volatility of stocks and provide stability to your portfolio, especially during market downturns. In conclusion, bonds are a valuable tool for investors of all levels. They provide a way to participate in the financial markets, earn a steady stream of income, and manage risk within a diversified portfolio. Understanding the different types of bonds, their risks, and how they can be integrated into your investment strategy is crucial for achieving your financial goals. Remember, investing is a marathon, not a sprint. By making informed decisions, diversifying your portfolio, and staying focused on your long-term objectives, you can navigate the complexities of the financial markets and achieve financial success. Thanks for watching. Subscribe to the channel, like and share for more informative videos.